Furthermore, market mechanisms that underlie the ecosystem quoted passive funds have experienced several shocks. The last two in chronological order, the mini-market crash of the 6th of May 2010 and the panic that hit the market August 24, 2015, when some ETF exposure to the US stock market lost a few tens of minutes to 50% of their value, while the index had fallen by 5% only. These events should serve as a painful reminder that investors pay attention to the purchase or sale of ETFs, says Ben Johnson. Morningstar analysts have repeatedly insisted on best practices in trading ETFs. Here are 5 F&O tips to keep in mind. Use of limit orders, limit order English year. When there is a large gap between supply and demand, place a limit order which limits the price you are willing to pay, that is to say, placing an automatic purchase order when the market price is at or above a certain value, or selling when the market price is equal to or falls below a certain level, and wait until the market moves in this direction can be notified. Market orders, market order, which are executed immediately at the best available price at that time, are a good choice for highly liquid ETFs with tight spreads. On the other hand, the risk of using a limit order is to see not run, or run too late. If possible, negotiate replicated when the market is open. If you negotiate an ETF that replicates the foreign markets with a different time zone, it is preferable to perform transactions when the underlying stock market is open. Indeed, for the leaders of the market makers, it will be easier to keep the ETF price close to its net asset value, NAV. In a closed market, estimating the NAV becomes more difficult and less reliable. Learn the difference between the NAV and market price. Avoid orders around the opening and closing of the market. Morningstar analysts recommend avoiding orders in the last 31st and 30 minutes from the stock exchange session. At the opening, the ETF prices can be influenced by the difference, premium or discount, between the closing value of the previous day and the net asset net worth. Ditto for the closing of the market, when market makers often implement outstanding positions of hedging strategies. These factors increase the volatility of ETF, which often causes rapid changes in prices and thus increase the spread. Before placing a large order, make a phone call. Investors who plan to spend a significant size order should use professional help. There is no official definition of large order, said Bob Johnson, but in general a transaction that exceeds 20% of average daily volume of the ETF or 1% of its assets under management fits this description. In these cases, we can get better terms, such as lower transaction costs, by contacting the issuer of the ETF or a market maker, whose coordinates are normally available on the website of the relevant exchange. If you do not value the intraday trading, it is best to use a traditional mutual fund. ETFs are not for everyone. If you do not have the time, resources or inclination to follow the F&O tips for intraday markets, or if you simply do not rate being able to exchange the fund during the trading day as an important feature, it is certainly better to choose a non-exchange traded fund that reproduces the same index.